Good morning, everybody, and welcome back to Beat the Bell, presented by Kane Capital. Glad that you guys are joining us. I hope that everybody had a phenomenal weekend. Last week was a really fun trading week. We got some actionable price action. We got some really nice moves in the market. Now the question remains, will we get more of the same this week? To talk about it, we got an awesome panel with us this morning, starting with Money Mander. Money Mander, good morning to you.
Top of the morning. Happy start to the week. Technically still in range, but actually getting some good price action back. So I'm excited for the week.
All right, Diamond Trades, good morning.
What's going on, Alejandro? Let's get the week started. Excited. Should be a good one.
And Ramsay Rippers.
Ready to go. Let's do it.
Phenomenal stuff. Let's dive straight into Fed forecast and economic calendar.
Yep. Let's start with the economic calendar first for this week. So we have got limited high-impact news this week. We do have some Fed speakers today before the market open and around that 10:50 time Tuesday. Some more Fed speakers, S&P, PMI flash, and new home sales. Wednesday, we do get the FOMC minutes release. So not a interest rate decision meeting, but a minutes release. These have been they've had like a bit of a muted impact on the market the last several times. We've had the FOMC minutes release, but still something that we want to pay attention to. Thursday, GDP estimates for Q2, as well as corporate profits, initial jobless claims, and then pending home sales. And then on Friday, probably the busiest day of the week in regards to high impact news, core PCE, personal spending, durable goods, and then the UMISH, consumer expectations, consumer sentiment, and inflation expectation numbers on Friday. So Friday will probably be the busiest day of the week before the long weekend. So that will be something to pay attention to going into the end of this week. Let's talk about last week. Last Friday, stocks did pull back a little bit, ending the week with a red day after a largely, bullish week. I would also point out that we did all pick green on Bet the Bell on Friday, which is probably your first sign that we were going to have that pullback. But, the pullback came following discussions to raise the debt limit stalled on Friday with the White House and House Republicans basically failing to reach a deal. House Speaker Kevin McCarthy said to reporters that spending levels were a major sticking point, with House Republicans looking for deeper spending cuts than House Democrats were willing to agree to. The White House did warn over the weekend. They came out and actually said this, that a government default could lead to a stock market decline of as much as 45%. So that's from the White House themselves. Important to note that. That's where they see the stock market going. If they do should the U.S. government default on their debt, look out for a 45% correction. So we'll make sure to be all over that should it happen. Powell also spoke on Friday at an economic conference in Washington alongside former Fed Chair Ben Bernanke. At the press conference, Powell did give a hint that he's considering pausing interest rates going forward after very aggressive increases over the past 12 months. When discussing the Fed's focus is more on inflation, bringing down inflation with the recent turmoil in the banking sector, Powell said until very recently, it has been clear that further policy firming would be required. As policies become more restrictive, however, the risks of doing too much versus doing too little are becoming more balanced. So the markets did move on that as well. The Fed Fund futures are now pricing in a 90% chance of a pause at the June meeting versus 82% just before Powell spoke. So added 8% there to the probability of an interest rate pause going into June. Mander, what do you make of the market moves that we saw late last week as Powell, gave some hints to the market there?
Yeah, the squeeze was on. And really for that Fed countdown there, it was up from, I think, like 68% midweek. So I guess throughout any economic data we got last week throughout the rally, bond market started to price in back towards that almost certainty of a pause at the next meeting. And it's a phenomenal segue to what I wanted to cover, which is the 13-week bond yield and really just shorter dated treasuries in general right now. Amid this massive rally we saw really year to date, but significantly the past week as we move into this probable and almost certain pause at the next meeting, right? You would expect, at least fundamentally, that bonds would start to get bought. If the Fed is pretty much at a certain to stop raising rates and pause them there, people should start to get some appetite into the treasuries now, especially at over 5%. to me at least, and historically, this is what we've seen. As you get towards the end of that QT cycle, that's when people get appetite to get back into the debt market, because you get out of the way when they're hiking rates. That way you don't get a bond that becomes trading 60 cents on the dollar as they're done. But as they start to finish the hikes, you would expect people to start getting an appetite into debts and treasuries, which we really haven't seen. The 13-week bond yield just hit a 20-year high last week, going over 5% on the 13-week. So to me, I'm really interested in this move. Obviously, whenever you see a discrepancy between markets, I like to look into that and see why dip markets are pricing in different things. And this linear relationship between stocks and bonds is typically something you see at the end of a QE cycle, when rates are getting back to near zero, with investors then getting out of the safe haven and exposing risk back into equities. But right now we're seeing risk back onto equities and getting out of the way of bonds really towards the end of the QT cycle, which is something we've not really seen. If we go ahead and take a look at the correlation here between the S&P 500 and the 13-week, usually you see them get this intersection here as stocks have had their correction at the end of the QT cycle and rates go back to ZERP and back near zero is where you start to see the correlation and the parity move between the two after stocks get extended during the bull cycle and the QE cycle, right? Right now, we're at the end of the QT cycle with rates at highs and the stocks are still going up. So I think that's really interesting to see how this pans out. Obviously, whenever markets are pricing in two different things, one's going to be right, one's going to be wrong. What one do you think is going to take this one? Because I think it's really interesting, especially the correlation here we've never seen over the past 20 years, as you can see.
Yeah, I continue to think that for the stock market to really have a pullback of, I guess, significant proportion, we would need almost like a black swan event. I think that you've thrown a lot of these curveballs at the market, and they've sort of stayed in there, stayed resilient, fouling off pitch after pitch, right? Like, it's very hard to strike this stock market out. Like it's not, and I think that this has been the case really since last year too, right? Like, even if you remember when the market gapped down on the invasion news, right? Russia was invading Ukraine, the market gaps down, and then that was literally the low that was like a multi-week low. We rallied so aggressively off of that. I think that if you look at really since this correction started in early 2022, every single time that something has come along and investors believe, okay, this is what it's going to be to really cause some capitulation in the market, get us down like 20, 30, 40%, something aggressive, and then we can all come back in and buy. And the thing is, people want that too, right? Because of how much cash they've got on the sidelines sort of built up over the last 2 years, whether it's from, actually saving money, or whether it's from, the excess sort of capital that you have from the 13 years of ZERP. You want this market to go down so that you can go ahead and buy with the cash that you have on the sidelines. And it's like, everybody's in that same position. It doesn't happen that way. It doesn't, everybody can't buy the lows, right? And so I think that every single time that we get an event like we're seeing right now with the whole debt ceiling thing, where it comes down just a little bit, and then people with cash on the sidelines, of which there are many, come in, buy the market up, and that sort of gives us this give and take market that we've had so far. So I really continue to believe that it's going to need to be something of somewhat of a black swan event to really crack the market and really send it down aggressively at this point. And so, I find it hard to see us really pulling back substantially any other way. That's just how I've looked at it over the past, couple of months. What about you?
Yeah, I think without something, like you said, something completely out of left field that's not even close to being priced in, like a black swan event like that to bring us down, is really what it's going to take. I think it's really interesting to see the appetite people want for these mega cap companies that are really at the point where they almost can't mess up, right? Like, if you're Apple with, what do they even have in cash reserves? Billions of dollars, right? You're at that point where you can't go wrong. I think it's interesting to see that a 13-week bond can be over 5% and people still don't want it. Like, a risk-free 5% in 13 weeks, obviously annualized, but people still don't want that because of the appetite for Google's, for NVIDIA's, for Apple's, for Microsoft's. And I think, to your point, that it's going to take a black swan event to change that narrative.
51 billion on hand for Apple, by the way, in cash. That's it for me, though. That's it for Fed forecast. We will pass it back to Alejandro.
All right, fellas. Thank you. Awesome segment this morning. A lot of interesting stuff there. I'm going to go ahead and share my screen. We're going to take a look at the system. So we recently got the buy signal on the 30-minute chart, which we're looking at up here. That's, of course, the bullish cross of the 10 SMA over the 50 SMA. But for a long period of time, I wasn't looking at the system. I wasn't using the system to trade because look at what was going on here. We were in an extremely tight range, ping-ponging between levels. When you're using a strategy that relies heavily on moving averages and there's no movement in the market, you're not going to do well. So when things get choppy, as they were, you have to adapt, okay? And all we were looking at and all I was paying attention to was simply my levels, trading the levels and really focusing on that. Now that we've gotten a breakout, we can see that we broke out to the upside and now we're trading above the 50 SMA on both the 1 hour and 30-minute charts. So what this tells us is that bulls are in control, okay? So very important now. Why is this important? Because we can look for certain setups now. I love to look for longs or opportunities to buy dips whenever we're trading above the 50 SMA on the 30-minute and 1 hour charts. So what the system does is it lets me know who's in control, bulls or bears, and where are the odds in my favor, if I'm trading long or if I'm trading short. So very important to note this. Clearly, you can see we're trading above both the 50 SMAs, and when the two charts are telling the same story, that's when the magic happens. So keeping an eye on this chart, and I won't say that bears are back in control until we break down below the 50 SMA on both the 1 hour and 30-minute. If you guys remember, through late March and nearly all of April, we were trading above the 50 SMA on the 1 hour. If you go back and you look at the chart, you can see how we trended through the entire month. And had you been using the system, you would have known to look for opportunities to buy dips. Okay, so that's the system. I'm now going to share some ES levels, and we'll take a look at the game plan that we have coming into today. Give me 1 second. Well, it looks like I'm having some technical difficulties. Here we go. All right. So here's ES. And these are my levels. So jot them down if you wish. I'll be sharing them throughout the day as well. Right now, we're sitting between 4210 and 4200. 4210 was clear resistance from Friday. Another thing here, guys. When you get a 100-point rally in the market, as we got last week, things slow down. If you remember the past couple of weeks where we were trading in a super tight range, what was it, like 10 days straight? We spent 2 weeks trading in like a 100-point range, or like a 60-point range. We weren't getting much movement in the market. That was after a giant rally. So last week, we got a giant rally. Now, coming into this week, it's important to be very, very patient and to not be overly aggressive, because that's one of the biggest mistakes that traders make. You get a giant rally, you get really excited, you want it to continue, you come into the market looking to just hammer everything, but the market needs to slow down. It needs to figure out what it wants to do next. So we can use these levels. It doesn't mean, don't trade, but we can use these levels to kind of narrow in and understand where price is likely to head. Once we clear one level, we head to the next, etc. So there was actually a nice setup that presented itself last night. I wasn't around, I wasn't trading, but we got a break below this 41.93 support and a reclaim. So this is a nice false breakdown setup that got put in. As you guys can see, 41.93 was huge support on Friday. 1, 2, 3 tests. Finally broke last night. Trap shorts thinking we're breaking below this 41.93. We lost heavy support. They rip it right back up. And now we are climbing. We just tapped 42.10. So that was an awesome setup. I didn't take that trade. As I just said, I wasn't around. I wasn't trading. So it's time for me to be patient. And as I said, I love to buy dips whenever we're trading above the 50 SMA, especially after things have cooled down. Normally, if you get a giant breakout, if you get a technical breakout, the first 2 days, the first 2 or 3 days, the third day is a little bit more risky, depending on how strong the move is. But the first 2 days are those opportunities to play the breakouts and to be aggressive. But once the market needs to slow down, it tends to punish those who chase. And so it's going to be very important to buy dips. An area that I'm loving to buy a dip at would be back in this 41.93 down to 41.82 region, looking for these false breakdowns where we trap shorts for opportunities to go long. But if we can clear over this 42.10, we've got 42.16 and 42.25. Rational market high is 42.29 today. And then a big spot is up here between 42.40 and 42.44. So that is what we got going into today. All right, now over to Ramsay Rippers for Bet the Bell. For the system, I'm going to pass it over now to Ramsay Rippers for Bet the Bell. Good morning.
Good morning, guys. All right, good morning, guys. Let's get into the stat check and then green or red. Ryan, pull it up. What do we got? The win percentage.
Full leader. Wait, what's
Whoa,
going on?
whoa. What is that?
That's
Should we bring him in?
yeah, what's going on there?
Yeah, we're going to have a chat with him about that.
That's something else.
Standings completely tied. Look at that. Tied for first. We're heading into the playoffs very soon. Who's going to be the first seed? All righty.
Go.
Let's rip it. The Qs are flat. Indices completely flat, barely up a few percent, like 0.1%. Same thing with the Qs. What do we got today, green or red, guys? Alejandro.
Green. I think we're going to get another green today.
Diamond.
I like green as well. Green.
Mr. Mander.
After Friday, I got to take red. I'm gonna jinx the green day if I do it again across the board. So I'll take red.
Taking red. All right, Ryan, pull up the chart. We're going to talk a little bit of energy, a little bit of XOM. I'd like to hear from my economic guys. We haven't really spoke about the energy market in quite some time. So what I want to know really is, is XOM sort of topped out and looking for that role that really the broader market and analysts were looking forward to coming into the beginning of 2023, moving into 2023. And we spoke about this towards the end of 2022, the highest put open interest for large funds and large investors was in this energy sector. We're starting to see that XOM is having some trouble again at that 118, at those all-time high levels. Had a really strong pullback in the last 2.5, 3 weeks, down about 15% off those highs, but holding the 100 to 102 support zone, that support level. Chart looks a little bit like SPX within that 130, 150 point range that we were trading in, kind of staying within that range. Small bounce off of that, the bottom of that range earlier last week. What do you guys think about XOM? I'm searching for your thoughts. We'll start with Mander.
Yeah, I do think this probably topped out. I'm looking at the chart here to my left, and it's really been in a very linear up channel really since the start of that breakout in 2022. But I think just given economic wins here with inflation cooling off, and especially XOM in particular with the outperformance it's had, if this gets a break under this channel that it just held last week, very likely then it gets back under 100, probably sees 90 and below. So I do think the top's probably in this one, especially if you look at the daily chart, grabbed all-time highs and just rejected straight off of that.
Fair. I like that. Diamond.
I mean, the daily looks like a distribution, at the highs. Each higher high is getting sold off there. And so for that reason, I'd like to say yes. I think from a fundamental perspective, I understand what Mander's talking about with, peak inflation and inflation having coming down and, but I think that case has been made. I guess the fundamental bear case has been made since like the start of the year in XOM, and it hasn't really done much. This is one of those names that it's like, if you're still trying to trade it, it's like a personal thing. Like you have a personal vendetta against it. I think that it's better to just like set it and forget it. If you think it's going to go down, buy some put spreads and sort of leave it. I think this is going to be a tough one to time, and I think when it finally cracks, it's going to go pretty quickly. So yeah, from a technical perspective, I'll say yeah, but from a fundamental perspective, it's hard to really gauge what the next 6 months are going to look like in the energy space.
Gotcha. All righty, beautiful. Let's move on to our last question. Ryan pulled the tweet via Unusual Whales. A little bit of Jim Cramer this morning. Cramer was in the news stating that he believes that there is a significant economic tear that is to come for the overall market. He believes that the market and investors are in for a nice run to the upside. I believe he mentioned something about how artificial intelligence, due to like the increase in AI and ChatGPT, the market's gonna rip. I mean, to me, I personally think that we've already seen that rip. I mean, shit, Nvidia's up almost 200%. Is it up 200%? Yeah, it's up over 200% off of lows. Seems like, when you state AI in these earnings calls or whenever the hell you want, your stock and your market cap automatically increases a few percent. So what do you guys think? Is it time to fade Kramer again? Mander?
Definitely time to fade Kramer on this one. I think it's one thing to understand market mechanics and understand why people have been flowing into magnets, why we've had the increase in liquidity off the Treasury balance sheet that we talked about last week, right? I think there's a lot of different factors that have played into this rally, AI being a big one, like you noted. But to say we have an economic wave here, that'll be fantastic for investors when you're nearing the end of a QT cycle here. Like rates are at 5%. So economically, we're not going to be going to a 4% GDP growth like anytime soon. So that's a big fade Kramer on this one.
Hondo.
Yeah, so sticking true to my guns, I talk a lot about how the macro environment seems to be having less and less of an impact on the market, and really the movement in equities. So sticking to that, I'm not going to say that when things are tough, and then on the other side of things saying that the macro is going to turn for the better, and then come here and agree with Kramer that yes, the market's going to rally because of some economic turnaround. It doesn't make sense. So again, sticking true to my guns, I think what he's saying, whether the macro turns for the better or not, I think it's quite honestly irrelevant. And I don't know. I definitely do not agree with that statement, because what I've heard or what we've been hearing is that things are certainly not getting better. So it's just important, I think, to look at things from a technical perspective or a fundamental perspective. But I don't know. This guy says a lot of crazy stuff. So
Noah.
I mean, Kramer, I don't want to agree with him. I don't want to agree with him here. I think what is he talking about? More or less like a soft landing, right? And I think so far, I mean, he's been right. Like not like his calls have been right, but so far in the sense of soft landing, he's been right. I mean, unemployment is low, inflation is coming down. Like as long as the United States doesn't implode with the debt ceiling thing in a few weeks, it doesn't look all that terrible. I mean, it really doesn't. Like if you actually like take a step outside of like Twitter for a few seconds, like things don't look atrocious here. Like I think if you go on Twitter, it's a lot of earnings recession and corporate profits are falling and X, Y, and Z for why the market's going to be at 2,400 in 3 weeks and all this stuff. And I think, realistically, things don't seem to be that bad. Prices are coming down. I think that we've seen that. I think that unemployment is still low. We've seen that. There's still available jobs for people who want to work. We've seen that. So, I mean, I hate to agree with him, but like I do in a sense that if things continue on this path, like I talked about before, with where it seems like we're all waiting for something to happen, waiting for a shoe to drop. As long as that shoe doesn't drop, I mean, Kramer kind of has a point. Like things don't look atrocious. So,
so my thing with this this tweet or this specific statement is the economic wave part. So the average length of a bear market is like 300 or so days, like 330 days, and we're past that point. So to continue to try to anticipate or guess what the economy is gonna bring next is my problem. All of the second half of last year was a phenomenal opportunity for investors, regardless of what was going on with the economy. So I think, again, to try to predict what the economy is going to do next or what the future looks like should be completely irrelevant to people who are truly investing.
Good points.
Beautiful. I love it. Appreciate it. That's going to do it for Bet the Bell. We'll pass it back to Hondo here.
All right, guys, that's going to do it for this morning show. Again, happy Monday. Hopefully everybody's excited to trade. Hopefully you guys all had an awesome weekend. Remember to trade smart this week. manage your risk. Again, things might be choppier. We'll see what the price action looks like. We'll be trading live, as always, all day in the Kane Capital Discord. You can go to kane-capital.com to sign up. We've also got that 7-day free trial going. So we would love to have you guys join us. But other than that, that's going to do it for this morning's show. And we will see you guys back here on Wednesday morning at 8:30 a.m. Eastern Time.